On July 17th, Nvidia briefly lost its crown as the most valuable company on Wall Street. Its shares were falling as another lower-cost Chinese AI model revived an uncomfortable question about the entire boom. What happens when the companies racing to build artificial intelligence decide they have finally built enough? 5 hyperscalers may spend roughly $750 billion on capital expenditure in 2026 alone. Not all of that money goes to Nvidia, but Nvidia sits near the center of the machine it creates. This is how a failing graphics startup became the toll booth of AI, and why that toll booth still depends on traffic. In 1993, Jensen Huang, Chris Malachowski, and Curtis Preem founded Nvidia to chase a new market in computer graphics. Personal computers were becoming entertainment machines, and realistic three-dimensional images promised to transform games, design, and digital media. Nvidia launched its first chip, the NV1, in 1995. The company had arrived, but with the wrong architectural bet. According to Huang's later account, Nvidia's strategy for Sega failed so badly that the company faced extinction. Huang says Sega's leadership nevertheless provided a $5 million lifeline, giving Nvidia time to abandon the failed direction. In 1997, Nvidia released Riva 128, the product that finally placed its graphics business on scalable ground.
The crucial decision was not stubborn persistence. It was preserving the company by killing the strategy that created it.
Nvidia survived because it changed architectures quickly, then repeated that willingness whenever the computing market moved beneath it. But graphics hardware alone could never create the empire that followed. Fast chips are copied, undercut, and eventually replaced. Nvidia needed something harder to reproduce. A reason for developers to build their work around Nvidia before buyers arrived. A central processor handles many kinds of instructions. A graphics processor performs enormous numbers of similar calculations in parallel. That architecture was built for pixels, but the underlying mathematics also appeared in science, simulation, and machine learning. In 2006, Nvidia introduced CUDA, opening its GPUs to general computational workloads beyond graphics. CUDA transformed the chip from a specialized component into a programmable platform, surrounded by tools, libraries, and documentation. Every program optimized for that platform made the next Nvidia purchase easier, and switching to another architecture more expensive. Then, in 2012, a neural network called AlexNet trained on 2 Nvidia GTX 580 graphics cards. The original paper says the training took 5 to 6 days and delivered a dramatically lower image recognition error rate. AlexNet did not create modern artificial intelligence, but it demonstrated what GPU acceleration could unlock for deep learning. Researchers noticed the performance. Developers adopted the tools. Cloud providers began turning that ecosystem into infrastructure. Nvidia had spent years building a road before the world understood how much traffic would eventually travel across it. When generative AI finally exploded into public view, Nvidia was no longer selling one remarkable chip. It was selling readiness. In the first quarter of fiscal 2027, Nvidia reported a record $81.6 billion in revenue. That was 20% above the previous quarter, and 85% higher than 1 year earlier.
Data center alone generated $75.2 billion, roughly 92% of the company's quarterly revenue.
Data center revenue had risen 92% in 1 year, extending an already exceptional sequence of quarterly expansion. Nvidia's GAAP gross margin was 74.9%, an economic result closer to software than conventional hardware manufacturing. For the following quarter, Nvidia guided to $91 billion in revenue, plus or minus 2%. These are not the numbers of a speculative company waiting for demand. They are evidence of demand already arriving. Yet the scale creates a new problem. Growth this exceptional can continue only if enormous customers keep expanding. Nvidia now describes a platform spanning processors, networking, systems, software libraries, models, APIs, and complete computing frameworks. The gold rush did not merely increase chip sales. It allowed Nvidia to expand from supplier into industrial architecture. An AI data center is not a pile of independent processors. Thousands of components must behave like one machine. Nvidia's 2020 acquisition of Mellanox brought high-speed networking deeper into the platform, connecting processors across massive installations. GPUs perform the computation. Interconnects move information. Networking links racks. Libraries determine whether developers can use everything efficiently. Nvidia increasingly packages these layers into rack-scale systems, shifting the customer conversation from individual chips to complete infrastructure. That matters because the slowest connection can waste the performance of the fastest accelerator inside a billion-dollar facility. Nvidia's moat therefore exists in several places at once: silicon, networking, software, developer habits, and deployment experience. But its largest customers are also building alternatives, including Google's TPUs and Amazon's accelerators. Their existence does not prove Nvidia has been displaced. It proves buyers want leverage over their most important supplier. Nvidia's response includes NVLink Fusion, designed to connect its ecosystem with semi-custom infrastructure and custom. Even when customers build part of the machine themselves, Nvidia wants its connections to remain inside the system. In the latest quarter, 3 direct customers represented 21%, 17%, and 16% of Nvidia's total revenue. Together, those customers accounted for 54%, a concentration powerful enough to accelerate growth or expose a sudden retreat. Nvidia also estimated that one unnamed AI company contributed meaningfully by purchasing cloud services from Nvidia's customers. The filing does not identify that company, and this film will not pretend to know what Nvidia chose not to disclose. During fiscal 2026, Nvidia invested $17.5 billion in private companies and infrastructure funds. Some of those companies buy Nvidia products directly, while others consume them through cloud providers and infrastructure partners. Nvidia also disclosed $3.5 billion of guarantees connected to land, power, and shell commitments for early-stage partners. These relationships are disclosed facts. They are not, by themselves, proof that revenue is fraudulent or demand is fake. They reveal something subtler. Nvidia is using capital to accelerate the ecosystem, whose expansion also increases demand for Nvidia. The question is not whether the network exists. It is how dependent the network has become on continuous expansion. S&P estimates Alphabet, Amazon, Meta, Microsoft, and Oracle will spend about $750 billion in 2026. That would equal roughly 38% of their combined revenue, an extraordinary commitment to future infrastructure. This is the title's $700 billion gamble. It is combined capital expenditure, not money paid entirely to Nvidia. The spending includes buildings, power, cooling, networking, processors, and everything required to turn electricity into artificial intelligence. Nvidia benefits because each new facility creates demand for the accelerated computing platform it has spent decades assembling. S&P says strong earnings show the investment is beginning to produce results for several major hyperscalers. But it also warns that the capital surge can compress cash flow and increase dependence on external financing. Each company is spending partly for opportunity and partly because underbuilding could surrender the next computing platform to a rival. That fear becomes a flywheel. One hyperscaler's expansion pressures every competitor to announce a larger and faster build-out. Nvidia sells the machinery into that race, while helping partners obtain the capacity required to keep the race moving. The empire, therefore, rests on a difficult proposition. Artificial intelligence must eventually justify infrastructure spending at unprecedented scale. At fiscal year-end, Nvidia said it had been effectively foreclosed from China's data center computing market. Earlier H20 restrictions produced a $4.5 billion charge for excess inventory and purchase obligations. Nvidia's latest outlook assumes no data center compute revenue from China during the following quarter. Meanwhile, US regulators moved H200 class exports to case-by-case review under security, testing, and supply conditions. The result is neither a clean reopening nor a permanent, simple ban. It is an unstable operating constraint. Nvidia also depends on foundries, including TSMC and Samsung, plus advanced memory suppliers across a concentrated Asian supply chain. At fiscal year-end, manufacturing, supply, and capacity commitments totaled $95.2 billion. Nvidia had also committed $27 billion to multi-year cloud services for its own research and development. The company warns that annual platform transitions and customer infrastructure readiness can delay adoption and create revenue volatility. A rack-scale system can be late even when the chip works, because power, cooling, networking, and sites must arrive together. At the same time, customers keep improving their own accelerators, software stacks, and bargaining alternatives. None of these fault lines proves Nvidia's boom is ending. Together, they define how the boom could weaken. The brief market value reversal was not a verdict. It was a reminder that confidence can move faster than infrastructure. Nvidia's present economics are extraordinary. Record revenue, dominant data center growth, and margins few hardware companies can approach. That performance was earned through decades of architectural pivots, developer investment, networking expansion, and fortunate preparation for deep learning. But the same numbers reveal dependence. A small group of customers now carries an enormous share of the expansion. Nvidia is committing capital across supply, cloud capacity, and partners, while the industry commits capital around Nvidia. If AI produces returns at scale, this could resemble the infrastructure foundation of a new industrial era. If returns disappoint, the pressure will travel backward, from customers, through data centers, toward the platform built for endless growth. Nvidia did not merely win the AI gold rush, it built the road and bet that traffic will keep accelerating.